Good morning, everyone. Marty Missouri here. It is the 18th of June, 2025, 11:21 a.m. Pacific time to be exact. I give you the time because it is after the Fed's rate decision or policy decision today, but before the press conference. My schedule today pretty much demands that I come at you before Jerome Powell says what he needs to say. The Fed did not change rates. That was a given. They did still commit to or anticipate or estimate high odds of 2 rate cuts by the end of the year, which is interesting because they also ratcheted up their inflation projections going forward as well. So typically you wouldn't think of a scenario where rates are cut while the Fed is anticipating rising inflation. However, to make sense of that, we have to think about the Fed's concerns over their expectation for the unemployment rate going forward and just general economic conditions. Almost by definition, though, lower rates suggesting a weakening economy amid higher inflation rates, the term would be stagflation, a stagnant economy with rising inflation. I also think that the Fed is probably looking at the rate of inflation of late relative to the policy rates. In theory, with the Fed funds rate above 4% and inflation running around 3 or less, just in those terms alone, you could suggest that rates should be lower. But if they maintain them at a higher level, essentially you could view that as having some room to where they wouldn't be forced to hike rates aggressively, let's say, in that rising inflation scenario. And I would also say that I think this Fed does not have any desire whatsoever to rattle markets, and 2 rate cuts is what's priced in the Fed funds futures, and it's what the market seems to anticipate. I think if they would have dropped one of those rate cut expectations, as many in the market thought they would because of the inflation risk, that I think the market would have reacted negatively to that. As it stands right now, it's relatively flat. The S&P has been up as much as 0.4% after the announcement to up as little as, say, 0.14%. So basically it was kind of a non-event, and the language in the statement was very much like last month's. But again, the press conference often can set off some fireworks based on how Fed Chairman Powell reacts to the questions. The president this morning, I believe, said that he thinks interest rates should be 2% lower than they are and that the Fed doesn't know what they're doing. The scenario that would have the Fed funds rate 2% lower, and I think what he's trying to do is match it close to where they see the inflation rate, would be one where the economy is suffering mightily. And if they did do even a 1% rate cut when the economy isn't suffering mightily, on top of the one big beautiful bill that will get passed, that would be just something that would probably see treasury rates spike and, believe it or not, stock markets tank if it were to occur right now or anytime soon, while the hard data still really isn't rolling over. Soft data is showing some concerns. Home builder sentiment this week was very ugly. Consumer confidence is still kind of on its back foot, if you will. Companies are concerned. We've seen that in earnings projections going forward and so on. So let's just quickly run through a little bit of my notes here, and then we'll look at the charts, and I'll continue to ramble about current conditions as we go. So this is something I put in here yesterday. Bank of America's credit card spending data jibes with the weaker than expected May retail sales numbers. So here is what B of A is seeing across various categories: electronics, airlines, restaurants, and lodging. And here's the beginning of the year. And interesting, spending on airline tickets has dropped a ton. We've talked about that already. Flights are getting canceled because they're just not seeing the demand. Certainly in the coach seats, they're still seeing ample first class and business class travelers, but the bigger part of the plane is not getting filled any longer. Lodging, along with airlines, you can see that the green line here, credit card spending has been waning as it relates to lodging. Restaurants kind of came down, then maybe you get some revenge spending here as people said, hey, we didn't go out enough. And you can see that's just kind of in that flat zone there. Electronics, I think this probably is very obvious. This was the big ramp up ahead of the tariffs, and this is the aftermath. So it generally somewhat notable when you look at airlines, weaker look when it comes to credit card spending. May retail sales, you can see month over month, they were down 0.9%, which is notably worse than the consensus estimate of down 0.6%. And when you take out vehicle sales, we actually expected a jump, and it was actually a 0.3% decline. And when you X gasoline and vehicles, they were down. So retail sales came in below expectation. It's not the end of the world. It certainly doesn't say we're in recession right here. But, combine that with other factors on the weak side of the spreadsheet, and it says, we should be thinking about the prospects for an economic slowdown this year. Beyond the U.S., and here's my note, despite what I expect may be some near-term underperformance for Eurozone equities versus the U.S. going forward, I remain bullish versus U.S. longer terms, bullish the Eurozone equities. So we have had a incredible run year to date in our European stock exposure, which is not small in terms of the explanation as to why we have so outperformed U.S. equities so far this year in our core portfolio. Gold and other things have helped as well. Here is my point, though, and I'm basically just agreeing with what Peter Bookvar highlights here. The June German ZU Investor Confidence Index in the economy, which jumped to 47.5 from 25.2, and 12.5 points above expectations. That's a reason to be somewhat optimistic. The change in leadership in Germany and pretty much just flushing the old zeitgeist where German policymakers lean in a very austere way when it comes to running budget deficits. They are going to spend a large amount of money going forward. And that is something that markets have hoped for a very long time. Markets, by the way, love deficit spending because it's net liquidity coming into the economy until it becomes inflationary, until the debt to GDP gets exorbitant or gets way above certain thresholds. And that's the U.S. today, folks. Certainly not Germany. It is the case in other countries within the Eurozone, but Germany is the big dog there, for lack of a better term. Almost the entire gain was in the expectations component. So obviously expectations are picking up over there. The current situation was still deeply negative, however, at a negative 72, but less so than the minus 82 in May. ZU said recent growth in investment and consumer demand have been contributing factors. This development also seems to strengthen the assessment that the fiscal policy measures announced, which I just referenced, by the new German government can provide a boost to the economy. Combined with the recent interest rate cuts by the European Central Bank, this could bring economic stagnation in Germany, which has lasted for almost 3 years, to an end. And the German index itself, in dollar terms for you and me, is up 31%. In euro terms, 17.6%, meaning that a good chunk of that 31% is explained by the declining dollar against the euro so far this year. Another reason why, if you think long-term, as we do, that the dollar trend is going to be lower, that there's going to be quite the advantage or quite the premium to be had buying non-U.S. assets in that scenario. So my point about the near term, though, is that if we do get some weakness in the summer, which I'm going to talk more about here, and I think probabilities lead in that direction, when you have, for example, Eurozone stocks that are up 25% and U.S. stocks that are up essentially nothing, and if the July 9th, the easing of tariffs, remember the higher tariff regime comes back July 9th, barring any new trade deals. But if it's a disappointment, I have to wonder if indeed we might see a little more give back in, for example, Eurozone equities than we do in the U.S. equities, just because of the positions that they'll be starting from. Now, having said that, recall that for months and months, if not the last year or two, I've been illustrating for you the massive valuation mismatch between U.S. and equities in other parts of the world. Eurozone has been one that just jumps off the page. Even with this big outperformance this year, there is still about a 50% discount from a valuation standpoint. Now, European stocks tend to trade at about a 20% discount to the U.S. over the long run, But again, I said 50%. So there is still, from a pure valuation standpoint, quite a bit of outperformance to be had over, say, the months and years to come in, for example, European stocks versus U.S. stocks. We'll still own U.S. stocks, of course, selectively. It's just that we will have a tilt to the rest of the world as long as our thesis continues to make sense, which it has notably so far this year. So remember last time, the last video, I talked about this narrative that, the dollar is at risk from a world reserve currency standpoint. It's really not. It is the transaction currency of choice by and large. But I did find this interesting. Again, Peter Bookvar brought this to our attention. This came from a Bloomberg article. This would be anecdotal evidence that, yeah, there are some decisions out there in terms of settling transactions that previously would have always been in the dollar are being done in other currencies. When Paula Cummings, for example, from the article, the head of currency sales at U.S. Bancorp, talks to U.S. importers, she increasingly hears the same message. Their foreign counterparts no longer want to be paid in dollars. Instead, they're asking for settlement in euros, in Chinese renminbi, Mexican peso, Canadian dollar, and so forth, as they look to limit their exposure to the further swings or potentially further swings in the greenback. A lot of clients previously were reluctant because using dollars were sacred in the eyes of the supplier. Now the vibe from overseas vendors seems to be, just give us our currency, and I find that fascinating. Here's an example. A lumber company from the Midwest now converts its U.S. cash into euros before paying for hardwood imports from Europe, a change from its previous practice of simply sending dollars. The move was spurred in part by a 2% discount offered by its European supplier for making payments in the single currency. Another client, a homeware retailer that imports from China, renegotiated its terms with suppliers and plans to settle its next bill in yuan. A third customer, a U.S. food company sourcing equipment from Italy, agreed to pay its dues in the common currency, causing it to receive a more favorable rate on a purchase worth 400,000 euros. And again, maybe this speaks to that downtrend that I've shown you, and I'll show you here in a minute, in the dollar of late. Finally, Carl Shimoda, chief market strategist at Cross-Border Payments from Corpay in Toronto. The change is difficult to quantify in real time, but in markets from East Asia to Latin America, a growing number of exporters are opting to dominate contracts in euro, yuan, and even local currencies. Major global sea change going on as times they are a-changing, so to speak. Well, we'll see. But this is interesting, and this is just a handful of, examples. Maybe there's more. Maybe it's not as bad as perhaps, some would believe. Think about the dynamics that are required to have your currency be the global reserve currency. Make no mistake, folks, there is no other country on the planet, no other issue of currency who can come close in general across the board to being the global reserve currency. That notwithstanding, as you can see in today's world, it doesn't have to settle every transaction. Okay, so let's jump quickly to the charts. So folks, same chart pretty much I showed you just a few days ago. The S&P has broken sideways out of this rising wedge pattern, and we do have very, very definite bearish divergences from a very high level. This suggests that the next major move is probably going to be lower, at least technically speaking. Good news on the international front, on the trade front, it could absolutely defeat these technical patterns, but right now, those in and of themselves are sending a warning flag to investors that the market's looking pretty heavy right here. Same thing for the daily chart of the NASDAQ 100 index, virtually the same thing exactly. As for the dollar, which I mentioned, it continues to bump its head against this very notable downtrend line. This is suggesting that there may be some signs of life for the dollar. We'll see. Wouldn't surprise me to see a pop in the dollar, and it would come from strong economic data and maybe something big happening that would be globally risk off. Tends to be good for the dollar, although I mentioned last time that that's not always playing out like it used to, which is providing fuel to the fire of those who think the dollar and U.S. Treasuries are in jeopardy right here. Speaking of U.S. Treasuries, they are sitting right now at 4.37% on the 10-year. You can see not much movement here relative to the Fed's decision. The press conference is going on right now. And so far, it doesn't look like Powell is disappointing the markets. Gold is sitting right against this upward trend line right here. Technically, this looks very much in jeopardy, short-term jeopardy. I say that every time. You break down below that resistance and through this trading range here, and I think gold could easily come down and touch its 200-day moving average. We are resoundingly bullish given that lower dollar narrative and the size of the debt to GDP in the U.S. and the budget deficits and so forth. We are very bullish on a long-term basis gold right here, but we think it's a bit overdone and due for a correction right here. And then lastly, I wanted to show you something. I was inspired to pull this up. I put together this chart years ago, actually, and watching BCA's live conversation this morning, their emerging markets analyst drew their attention to this, and I've been aware of this, but I haven't illustrated it for you for a while. So what this is, the top panel is the S&P 500. And the orange line down here in the bottom panel is the volatility index, the VIX. The VIX measures the price of implied volatility on S&P 500 options contracts. And typically the VIX goes up and gets very expensive when the market is in jeopardy. So what you see are these massive spikes during the real estate bubble burst, during the the tech bubble burst in here, during COVID, during this 20% decline, and so this is the price of those options going to the moon, folks. You've seen that happen in your accounts with our hedges, our put options on the S&P. They exploded here, they exploded here, and they mitigated a big chunk of the loss we would have taken. So when our analysis demands that we hedge, that's typically how we're going to do it, just to get a broad-based protection against something devastating in the U.S. market. But what I'm illustrating here, though, are the trends. There's a red flag, a big one, as I'll show you here. Historically, when the VIX is rising with a rising stock market, okay? So again, you expect the VIX to go up when the market falls, but when the VIX, when the price of volatility, implied volatility, is going up with a rising stock market, that says something about the underlying positioning in the marketplace, that essentially concerns are rising with the market, okay? And the phenomenon is just quite simple. You can see this was actually a few years, actually, of a rising trend in the VIX after just being rock bottom through the first half of the 90s. And while it was rising, we got a 20% correction here, and the market, as you can see, just started getting more volatile before it crashed by 50%, the NASDAQ by 80%. So we had that rising volatility. Here we had the market rising quite comfortably as the VIX was falling and stayed down at a very low level until it didn't. And come about the end of 2006, moving up into that late 2007, early 2008 disaster, 57, call it 60% decline, peak to trough in the S&P, you can see that the VIX was taking off to the upside while the market was still grinding its way higher as well. This was about a 16% move. I almost didn't illustrate that, but it is. We rose and then we came off and found support at a higher low while the market was still rising. Then we got that dip. During COVID, we definitely had, the VIX coming back, making higher lows, and this was a higher low from when it started to take off, and that was for the S&P a 35% decline just over a few weeks. Nothing really since then. We did have a 27% decline in here. You could argue that the VIX started to go up just here in the last few weeks, maybe before that fell apart, maybe the last month or two. But this one is quite noticeable. This is quite the divergence from the norm. Here we have the S&P coming out of that bear market. Right now we're threatening all-time highs again. We did get a 20% dip along the way, but the VIX has not come back down to earth from those levels. So this is a serious warning sign. As you can see, that we get into the summer, you get into July, it looks like the market is setting itself up for another perhaps double-digit correction. So we just need to just have our heads up and be aware of that. Doesn't mean a big bear market is coming, but it is suggesting, among other things, that we could see a correction in July. And those other things, kind of in closing, one would be, again, on July 9th, the reduction in the Liberation Day tariffs goes away. They're not going to go back to those Liberation Day levels, but something higher than here would probably be problematic for the U.S. equity market. The impact of the tariffs so far clearly have not shown up yet entirely anyway in the economy and the inflation readings. And it'll be interesting to see what the corporate earnings guidance is as we get into July and we get those second quarter earnings reports. A lot of companies would not guide going forward because of the uncertainty. So there's going to be some potential risk there. Target date funds that are just hugely populated inside of 401ks across the country. There's just a massive amount of money in these funds. They have set allocations to equities and to fixed income, and they tend to rebalance on a quarterly basis. And this last quarter, we have seen, the market come bounding almost all the way back from that 20% decline. You can see the bottom there was just at the beginning of the second quarter, and bonds are essentially flat to down on the quarter. So what that means is that when they redo their allocations or they rebalance back to their targets, they're going to be selling stocks and buying bonds. Now, a lot of people get very excited about this setup, and it hasn't always been the way the market and the people talking about it thought it would turn out. Maybe there's sufficient liquidity coming from other places to buy those stocks as they're rotated away from in those target date funds, but that's a risk as well. Fed policy continues to be a risk as the economy moves. And again, if we see inflation heat up with the effect of tariffs and we don't get any kind of a slowdown in the economy and the Fed announces that maybe there's only going to be one rate cut at the end of the year, that would probably be problematic for stocks as well. So I think, folks, technically speaking, and then from when you just think about the timing of some of these things I just mentioned, we may see some weakness in the market as we get into the summer months starting in July. In the meantime, clients' core portfolio is working very nicely this year. It's probably as all-weather as it's ever been. But obviously there's downside potential in any portfolio when you're dealing with global equities and commodities and so forth. We're still sitting on a pretty good chunk in short-term treasuries, part of our defensive posture right here as well. Folks, thank you as always for watching and listening, and I'll be back at the end of the week. Take care. Bye-bye.